Hello, good morning, good afternoon. Thank you for giving me an opportunity to participate in the Concept Invest Well 11th Wealth Creation Program. Hope you all are doing well in these unprecedented times. How the world has changed in a few months and will likely continue to be unpredictable and volatile. I remember coming to Surat last year, and it was such a grand event. Um, and I fondly remember the food also, which was fantastic. So, and now we're all sitting in our own homes, virtual offices, and these video meetings have become an integral part of our new normal. So, today I will talk about how artificial intelligence can be a game changer in investing well in these unpredictable environments. So, how does the current state look like? So, today's society, we've never seen anything, like what we experienced in the last few months, and neither have the financial markets. So, if you look at the domestic equity markets, after reaching record highs in January, they plummeted in what a couple of few weeks to alarming lows, costing publicly traded companies trillions in market value, and not just in India but like globally too. So in fact, the BSE 500, as you all know, that has a drawdown of like 30%, and with financial sector falling even more. So these kind of events, have obviously a profound, effect on corporate valuations, buying activity, as well as threat to the overall landscape. So how do we navigate these difficult markets now? So you look at the BSE 500 on an average perspective. If you look at year to date 135, and they are not getting investors are not getting compensated for the amount of risk they are taking in the equity markets. So it's like 6% return on an average over the last 5 years is less than what a bond market would give you. So why would you take on additional equity risk, right? So investors are seeking predictable ways to build wealth, a fundamental need requiring new and better solutions. So a few other questions that we want to ask ourselves is, are the portfolios just giving market exposure? So where do you turn to get predictable outcomes when technology and algorithms now dominate the markets? So, and does your portfolio dynamically adjust to the various market conditions, right? So in terms of extreme downturns or take on risk, when the market when the situation improves. So, and most importantly, the failure of active management. So there's a lot of fund companies that are charging exorbitant amount of fees, but does the returns justify the fees that they are creating? So let's talk about how we can address some of these concerns using our solutions. So here's another good example of all the last 8 years. Only 2 years have been good. This year, obviously, the markets have recovered a bit since the lows, but we are still underwater, right? So at IQCIO, we've been working to solve the challenge of generating better risk-adjusted returns, and through all markets, especially the turbulent ones, using artificial intelligence. So the opportunities exist and the computing power is there, and we now have the ability through our proprietary AI and quant methodologies to really build sophisticated portfolio solutions. So it's really an enormous opportunity and a differentiating factor for wealth managers all over the world to be able to use this powerful and effective technology to help them build their wealth, to build their net worth, and to be able to achieve the kind of financial goals that they've set out for themselves. Why artificial intelligence? First, let's talk about artificial intelligence in today's world. So AI is disrupting the status quo across a broad cross-section of industries by demonstrating its effectiveness as a powerful data mining, pattern recognition, and forecasting tool that can tackle challenges that no human or other mathematical based technology can achieve. You all know about Siri, Apple, or Alexa, Amazon have already worked their way into our daily lives as AI personal assistants. Social media platforms like Facebook have helped warm up the public to this disruptive technology that is reshaping nearly every industry and government worldwide. So at IQCIO, we use one of the most prominent methods, within machine learning for our predictions. So we use deep learning, which is a more sophisticated refinement of machine learning. So the key difference is that it can learn on its own independently through iterative learning or training process, similar to how the human brain processes information and arrive at intelligent decisions. Deep learning models, organize its processes into structured layers that form a artificial neural network that can learn from the data it was presented with and can make intelligent decisions and inform predictions based on what it has learned. So a major reason why artificial neural networks have become so popular is recently, then in the last decade or so, they are powered by huge amounts of data, and which increases their ability to learn and then make highly accurate forecasts. And this is also possible because of the considerable achievements made in computing hardware. So related to how these ANNs crunch its data, and with the availability of very scalable solutions such as Amazon Web Services, which is IQCI uses and based on, we are really able to scale up this technology and process these hundreds of thousands of variables and find these hidden patterns using artificial intelligence. So how do we use this incredible power of AI in the financial industry, especially within IQCIO? So artificial intelligence is the superpower behind IQCIO software. So what we've found is that artificial neural networks, when applied to the financial markets, most importantly, if they're designed and trained properly, they really work. So our system is a very flexible system that allows the software to provide wealth managers with highly customized portfolio solutions. So the way we do this is by creating accurate predictive forecasts of primary markets. So for example, a Nifty 50, BSE 200 or 500 based on their relationships with related markets. So which includes, for example, interest rates, commodities, global markets, and a whole bunch of other factors that affect the underlying price movements of the primary markets. So understanding the hidden patterns behind all of these data sets is very, very difficult for a human being to really accurately predict and understand those relationships. So this is where the artificial intelligence is the perfect solution for that, right? So and what we do is we try to forecast the market direction over the next 1 or 2 months. So our artificial networks have to be specifically trained in order to understand and learn the relationships between each certain primary market and its related intermarkets that influence the trend direction of each primary market, in this case like BSE 200 or 500, via identifying these hidden patterns. Right? So, and these hidden patterns across hundreds or thousands of variables are best suited with the help of AI. So we then take this incredible power of artificial intelligence and we blend it with our proprietary quantitative methodologies to generate portfolios that are designed to take risk when it's prudent and and looks good, while similarly trying to mitigate significant losses when market risks increase. So the dynamic adaptation is built into our process, which results in better capital gains and better alpha over the, the full market cycles. Let's dig a little deeper into how all of these different pieces, fit together in creating, better portfolios, like, better risk adjusted portfolios. So this diagram here shows the different pieces within our portfolio construction process, how they are interconnected with each other. So in the concept portfolios, what we have done is we worked with, Hemant sir's team, and we selected initially with a list of securities within a benchmark, such as an index such as BSE 200 or a 500 or Nifty 50. So what we have done is we've applied some fundamental filters to filter out any securities that do not fit within the investment universe for concept. So the concept has a phenomenal research team led by Siddharth, and what we have done is we've taken some few fundamental filters that they use, such as the debt equity ratio or a cash flow positive type companies, to reduce the filter. So in this case, let's say we talk about a BSE 500 portfolio. From 500 stocks, we've now reduced it to 200 or so securities based on these fundamental filters. So what we have done, the second step in the process, is applying various guardrails, right? So in discussion with the concepts research team, so applied high level of limits. So meaning what is the minimum and maximum in a large cap or a mid cap or a small cap, and various sector limits. So how much maximum exposure would you want in a financials or a technology, etc. So then we take all of this data and then we go, we feed that into our AI engine. So the AI engine is tracking multiple variables, like hundreds and hundreds of variables. So some of them are listed here on this diagram, such as global markets movements, the currency rates, USD INR. As we all know, there is a big dependency, especially within the IT sector space, on how the currencies impact their bottom line, right? So, and then oil prices. India is the largest consumer of oil in the world, so obviously we do have the population also. So, and those are like significant impact in how the economy is impacted. So then various bond market price information, yields, then commodities pricing, gold, copper, etc. So as you can imagine, now as you are feeding in more and more data, it's very, very difficult for a human being to put together all these relationships in a way that is easily understood, right? So this is where artificial intelligence and creating that artificial neural network, similar to how a brain would work, but with the incredible power of cloud computing that is available right now. So all of this is hosted on Amazon Web Services, so which gives us that incredible power to scale and run these algorithms very, very quickly and efficiently. So what the AI engine is doing is it's trying to find patterns using all of the historical data that is fed to it, and trying to learn what could happen to the markets based on all of these inputs that given the current state in the next 1 or 2 months. So what we take that is based on that prediction, we feed that into the third layer, or the circle that you see on the screen, the quantitative layer. So our quantitative model is a complex mathematical algorithm that focuses on creating risk-adjusted portfolios by minimizing extreme losses, as well as look for better return profiles. So it's looking for historical price movements, it's looking for the volatility of the underlying instruments, it's looking at the correlations and the interrelationship between the securities, and given the guidance by the AI, it's trying to pick the best portfolio to meet those needs. So, and we do this entire process either bi-monthly or monthly, depending on the market condition. So if we think it's like the situation has changed dramatically, then we reserve the right to do it on a monthly basis. But otherwise, these portfolios are rebalanced on a bi-monthly basis. So, and the system is dynamically adjusting to various market conditions to find the best possible solution suitable for that environment.